Welcome back to the Burr Investor Podcast, where our mission is to empower aspiring real estate investors in their journey towards building generational wealth. I'm super excited to introduce you to our special guest today, Jerry Avetisyan. Jerry's a CPA located out of the Glendale, California area. Jerry has been running his own CPA practice since 2008, specializing in business and real estate taxation, audit representation, and corporation LLC formation. When doing tax planning for his real estate clients, Jerry puts together a complex tax plan which often includes utilizing real estate losses to offset business income, accelerated depreciation of real estate property by utilizing Section 179 deduction and cost segregation, and ultimately paying the lowest possible taxes upon sale of the asset. Jerry, thank you so much for your time. Thanks for joining us today, and welcome to the Burr Investor Podcast.
Thank you, Alex. It's good to see you again.
Appreciate it. So, Jerry, obviously this is a podcast for, real estate investors in general, aspiring real estate investors. It's about the Burr strategy, which, entails buying and holding property, as well as fix and flips. So with that said, can you share with us what is the best entity structure to pay minimum taxes for a buy and hold and that for a fix and flip property?
Absolutely. So before you set up an entity, by default, everything will be reported on the individual's income taxes. Let me just start with that. If you don't have an entity, by default, everything is reported on the individual tax return. So a real estate investor that is buying, holding property with the intention of having rental income would report that on the Schedule E of the individual tax return. And if they're a flipper, then they're in the business of changing property, exchanging property. They're basically like a retail store. Then they would report that on the Schedule C of their individual income tax return. Now, this is great because it's easy to get started. You don't have to do a whole lot. You could just jump right in and get your business started. You don't have to set up an entity. It's easy to set up, or sometimes you need a DBA. And if you want to use other than your individual name, you set up a DBA and you're ready to go. The downside of that is that, of course, as we know, there's no liability protection. A individual will never get an investor to invest in them individually. Investors want an entity structure so they could be partial shareholders or LLC members. And also, if a person passes, the sole proprietorship does not continue on beyond the person. Okay. An entity has a perpetual life. In other words, an entity can go beyond the life of the owner. So for this reason, for some of these reasons, entities are very popular. So let me start here. It always depends on what the underlying reason is. So for this reason, if the person wants to buy and hold property for the intention of being an investor and collect rental property, typically an LLC is the better structure. It's the most common structure. The reason is because if the person holds the property over 12 months, they want to take advantage of, and they sell the property some 2 years later, whenever. But if they hold the property for at least 12 months, they can take advantage of lower capital gains tax rates. This is not going to be the case if they hold the property in an S corporation or in a C corporation. They're not going to get lower capital gains tax rates. So for this reason alone, a lot of people choose an LLC to hold investment property in. They can, if they at any point want to sell the property, they typically can sell the LLC. They can bring in an investor. They can add, it could be a single member LLC if it's just one person, or multi-member LLC if it's more than one person. So it's easy to bring in investors. It's easy to sell the LLC with the property inside. Typically, people that have investment in various real estate properties, they like to put each property into a separate LLC. Mm-hmm. And with this, each property is protected. So, for example, let's say a tenant falls and sues the landlord. If there is no entity, then all of the landlord's assets are up for grabs.
Got it.
So if someone has 10 properties, they don't want that. If the insurance has limits, but if the insurance doesn't cover the lawsuit goes beyond the insurance limits, then they're going to go and try and attach to other assets. And the rich don't want to do that. What they do, the people that have money, they spend a little extra money, set up an LLC. LLC has some extra costs associated with it, but it's worth the money. Because when you put a property into an LLC and let's say a tenant sues the property owner, they can only take to the extent of the amount of assets that's in that LLC. So for that reason, investors use LLCs to basically shelter their real estate properties. Now, LLC is ideal for real estate investors, people that want to buy real estate, hold it, rent it out, collect rental income. At some point in the future, they will sell it, they'll 1031 it. They can treat that however they want, but at the end of the day, when they sell the property, they can take advantage of lower capital gains tax rates. This is significant because the maximum IRS capital gains tax rate is 20% right now.
Okay.
The maximum individual tax rate is 37%. So you could see that there's a 17% difference, which that's a lot of money if it's a $2-3 million property.
Absolutely.
So LLC is wonderful for investors. Well, what about those that want to get into the business of flipping properties? Typically, they use an S corporation or a C corporation. S corporation is ideal for people that conduct business. They do buying, selling properties, or professionals, realtors, they typically use an S corporation. The reason is because there's some tax savings that you can have through S corporation. S corporation can pay officers, shareholders through two different avenues. One is through W-2 payroll. The second one is through drawings. So here's how it goes. If you have an S corporation, the officers of the corporation are considered statutory employees, and they are required to take some compensation out through W-2 payroll, which is how they pay their Social Security and Medicare taxes. They can also take out money through drawings. Officer draws drawings. Sometimes they call them dividends. Mm-hmm. This portion of the compensation is not subject to Social Security and Medicare tax, and that is 15.3% tax. So if you take an example, someone that's going to take $100,000 compensation from their S corporation, and they take half of that compensation through W-2 payroll, and the other half, $50,000, through drawings. Well, 15% of $50,000 is $7,500. That's the amount of tax savings to utilize an S corporation. So S corporation is a great vehicle for someone that's conducting business as opposed to buying and holding property. Mm. Now, S corporations and LLCs are considered flow-through entities. What does this mean? This is very important to understand. At the end of the year, once the year is over, income taxes are filed. The net income is calculated, which is the taxable income minus expenses. Automatically, the net income flows over to the individual, the shareholders, and they pay income taxes at their individual tax rate. You don't have a choice. It's not based on the amount of money you take out of the business. It is based on the net income calculation. So if the business made $100,000, the owner said, I don't need to take any of this $100,000 out. I'm just going to leave it in the business. You still pay tax on $100,000.
Got it.
That's the flow-through concept. And the taxation happens once. The income taxation happens once at the individual owner's income tax rate. Now, sometimes you have business owners that say, I have compensation through other sources. My wife works. I don't need to take that money out. I want to make money in the business, but not take the money out. How do I pay the least amount of taxes? Well, for that, C corporation is more ideal. Okay. And C corporation is not a flow-through entity. In other words, income taxes for the individual owner is based on the amount they actually take out of the business. But there's a catch. There's something called double taxation kicks in C corporations. The way it works is the C corporation pays tax at corporate level, and if the owner, the shareholder, takes, or an employee, anyone takes money out of the business, then they will pay tax on that income when they take the money out. However, the corporate tax rate is much lower than the individual tax rate. The maximum corporate tax rate is 21%, the IRS corporate tax rate, whereas the maximum individual tax rate is 37%. So there's a 16% difference. And if somebody was interested in leaving the money in the entity, not taking the money out, well, they might as well save on taxes. Leave the money there. It's called retained earnings. They will reinvest, and at some point when they want to take the money out, then they will take it out through W-2 and pay taxes on them.
Got it.
So to review, you don't have to set up an entity, but all your assets are up for grabs if you have a liability. And you can't have investors. There's no perpetual life with sole proprietors. LLCs have perpetual life. You can have LLC members. You can have investors. It's wonderful for that. Typically, investors use a separate LLC for each property in order to reduce the liability of one property going over to the other property. When they sell the property that's held in an LLC, they will still qualify for lower capital gains tax rates. Someone that's interested in buying, flipping property can choose between an S Corp and a C Corp. It's the better vehicle. They don't have to. They can operate as a sole proprietor. It will be reported on the Schedule C of their individual income tax return. However, if you want that liability protection, in case a contractor falls and sues you, then entity is definitely the better way to go. If they want to save on taxes and want to pay tax on all of the net earnings of the corporation, S corporation is usually better. If they want to not take the money out, they rather not take the money out, reinvest, and pay the least amount of taxes, C corporation is better. Of course, there are various other factors, and this is where tax planning comes in. Everyone should sit down with their CPA and have a tax planning session to understand what's suitable for them and the other benefits of each entity. But in a nutshell, these are the key determining factors.
This is great information, Jerry. Thank you so much. And there's a lot to unpack here. So, want to go back a little bit to what you mentioned about, having each property in a different LLC for an investor. And so it sounds like, if an investor owns, let's say, 3 properties, puts it in one LLC, if they get sued from a tenant from one property, they can go after the proceeds of other property.
That is correct.
Okay.
That is correct. If the LLC, think of it like a bucket. Whatever you put in this bucket, someone was to sue, they can attach to the extent of whatever's in that bucket. So for that reason, investors use different LLCs for each property. It's more expensive. There's cost associated with this. But if you got $1 million, $2 million worth of property,
it's protection.
You got to pay the extra cost. In our sue-happy state, anyone can sue for anything.
Yeah.
So this becomes more and more relevant for people that have more assets, have more money. If you own your home individually, you live in that home, you have a regular W-2 job working for the government, okay, you get an insurance, will cover a lot of liability. But if you have multiple properties, then now it becomes a concern. What if it doesn't cover? How much can they get out of me? If you don't put it into an entity, someone that's trying to sue you can chase you down for the rest of your life to try and collect, and anything you own, they'll continuously attach.
Yeah.
Whereas if it's in a separate entity, that liability will be limited.
So one thing I want to ask you about that, like, let's say if somebody has an LLC, owns a property, they sell the property, right? Outside of the taxation, would you recommend, closing out the LLC if they want to acquire another property, or can they still use that same LLC to buy another property? Like, can something come back at them and get them?
Great question. The answer is LLC has perpetual life. It doesn't die.
Got it.
Doesn't die with the property, doesn't die with the owner. If you don't close the LLC upon selling the property, you don't have to. You can bring another property. But if there is a liability, if someone does sue for that property that was in that LLC, then again, it's up for grabs. Yeah. So the wiser thing to do, unless you're assured that there's no liability related to the property that you're selling, is to close that LLC, get a new one. And the beautiful thing is you could close an LLC, get a new one every day. There's no limit.
Yeah.
So yeah, that is the better alternative to get a new LLC set up.
And that's like a conversation I have with many different people. It's always a debate. Everybody has their own, perspective of it. Do I close the LLC or do I reuse it? And, at the end of the day, just like you mentioned, yeah, it's an expense. However, it's a business expense, and it's an expense worth having because it's protection at the end of the day. So
Absolutely.
I totally agree with you. And so just for our realtor viewers that are watching us today, you did mention one thing that an S corp is probably the more appropriate entity for a producing real estate agent. Would that be correct?
That's correct. Someone that's in the business of flipping real estate is taxed completely different than someone that's buying and holding real estate. Someone that is flipping real estate is considered to be in the business of conducting business, real estate business, of what is called active income. And active income is subject to payroll taxes, Social Security, Medicare taxes, whereas real estate investment, rental income, is not subject to Social Security and Medicare taxes.
Got it.
So for this reason, oftentimes, if you have the choice to, let's say, have a W-2 job and make the same amount of money from real estate investment, you rather pick the real estate investment because there is the Social Security and Medicare tax that you don't have to pay. Not to mention, you can accumulate real estate. There's only so many hours you have to work for a job. But real estate, you can keep accumulating. At the end of the day, the asset itself appreciates. It's much more valuable than putting your personal hours. Yes, S corporation is the better route for someone that's in the business of flipping properties as opposed to buying and holding properties.
And can you talk a little bit about the minimum costs associated with having an LLC and that of a corporation?
Absolutely. It's not cheap. LLCs have minimum $800 annual tax that they have to pay the franchise tax board.
Okay.
You also have to pay your CPA some extra money to file LLC taxes. It's maybe a couple $1,000s a year extra expenses associated with having an LLC.
Okay.
So yeah, that's the case. $800 minimum franchise tax, and also the additional expenses associated with filing taxes.
And that applies to both LLC or corporation?
Applies to both LLC and corporation, absolutely.
Okay. And is there a limit to how many LLCs that one can own?
Great question. There's no limit. You can own as many LLCs as you want. Each LLC has its own tax ID number, its own state ID number, and essentially it's thought of as a separate person. Look at it that way. So an investor can have as many LLCs as they want. Each LLC has its own tax ID number. And it's also worth mentioning that if you have an entity set up, you can build credit. Mm-hmm. This is a very beneficial option because if you show income and you report it with Dun & Brad, over time, the entity itself can go get a loan. It doesn't have to be attached to you individually. So yeah, get as many LLCs as you want, and as long as you're comfortable with the expenses.
And I'm glad you brought up, the point of, building credit, because not many people know about that. Not many people know how to go about building credit for an LLC. There's a lot of little, nuances and ways to do it. And, what's interesting is we're going to be having a guest as well join us on the podcast on a different episode that's going to talk a little bit about that. So stay tuned for that. It's going to be the episode with Drew Kaplan. He'll definitely elaborate more about, the different steps of how his company helps out people to build their credit. So it's very, very crucial. So thank you. Can you talk about the tax exemption on the sale of a personal residence? And, will the exemption apply if the property is held in an LLC?
Right. Great question. Tax exemption. We're talking about the $250,000 or $500,000 exemption. So if an individual, single or husband or wife, live in a property as their primary residence, and they live in that property at least 2 out of 5 years, they don't have to pay taxes. Certain amount, they are exempt from paying $250,000 of tax on an individual and $500,000 tax. I'm sorry. What I'm saying is there's $250,000 of gains that they don't have to pay tax on. Mm-hmm. If they're single, and $500,000 of gains they don't have to pay tax on if they're married. So, for example, a couple live in a house for 3 years and they want to sell that property for $1 million. They bought it for $200,000. So there's an $800,000 gain. If they're married, $500,000 of that $800,000 is exempt from taxes. is exempt from paying any federal income taxes. The remaining $300,000 is subject to lower capital gains tax. So yes, $250,000 for single, $500,000 for married. That's the amount they do not have to pay tax on.
And again, that's your primary residence. You have to own it for 2 years. That's a huge, huge tip. I mean, not many people are aware of that. And, with my conversations with clients, when I'm helping them in the real estate, buying or selling, not many people realize that. And that's why they're, apprehensive on, wanting to sell their property just because they're afraid of what taxes they're going to pay. So thanks for sharing that. That's a great point.
A lot of people, I've had many clients, they bought a property, a year later they want to sell it because there was a huge capital gain. But they did not take into consideration the amount of tax they're going to pay, which is going to eat up. There was a huge appreciation. Now they have to pay tax on that, which is going to eat up all their profits.
Yeah.
So sometimes it's worth holding in for 2 years and then selling after 2 years because there is a $500,000 amount you don't have to pay tax on.
Now, can losses from rental real estate offset W-2 income?
Generally speaking, the answer is a no.
Okay.
Generally speaking, rental real estate is considered passive activity.
Okay.
W-2 income is considered active income.
Okay.
Income from passive activity does not offset income from active activity. So, active income is basically income you have to work for. W-2 jobs, CPAs, attorneys, lawyers, realtors, right? That's active income. Passive income is income that is income from investment. It could be stocks, could be real estate. For the purposes of our conversation, let's talk about real estate. So generally, no, but there are two exceptions. There is active participation rule, and there's the real estate professional rule. If you meet the requirements for active participants, which is you have to own the property you have to be at least a 10% owner of the property.
Okay.
And you have to be actively involved in the management, inspection, repairs, tenant application reviews. If you're actively involved in that property, then there is a limit of $25,000 that can offset active income. So wife makes $100,000, husband has a $25,000 loss from real estate activities. Their income reduces, taxable income reduces to $75,000.
Okay.
So that is qualifying for active participation, actively participating. The other option is if you are considered a real estate professional. To be considered a real estate professional, you have to spend at least 750 hours a year, and at least 50% of your working time has to be considered defined under material participation. Material participation is construction, buying, selling property, leasing property. You have to be materially participating 750 hours a year and 50% of your work hours. At that point, there's no limit.
Got it.
In the same circumstance, if the wife makes $100,000 a year W-2 income, husband has a $60,000 loss from rental real estate activities, their taxable income will decline down to $40,000. So yeah, those are the two exceptions if you meet the active participation or real estate professional requirements.
That's huge. And can you share with us some tax planning tips for real estate investors?
Absolutely. Well, the one I just mentioned, that's definitely a very important one.
Okay.
You have to document. Tax planning, you have to document. A lot of times people say, okay, yeah, I do all these things, but how do I prove it? That's right, you're in charge of proving. So you have to document it.
Okay.
You have to write your time down, when you visit, what you do for each property. You literally have to do this. If you don't do this and you're audited, trust me, the IRS is not on your side. So yeah, take the extra time, create a log, write down when you're going to each property and what you're doing. You have to prove that you are actively involved in repairs, inspections, and everything else that's associated with that property, active participation. And if, of course, you're a real estate professional, it's even more stringent. You're going to have to 750 hours a year. That's right. You have to have a log of your hours. They're not going to just take a common sense approach. They don't do that. You could get lucky with, but anyway, do not depend on luck when it comes to audits. I've done many IRS audits, and I'm going to tell you, don't depend on luck. You better have journals, you better have records. So yeah, you want to record your 750 hours, at least 750 hours, and 50% of your time. So if someone has a full-time job, is automatically not going to qualify. If someone has a full-time job outside of the real estate profession, they're automatically not going to be able to put another 750 hours and 50% of their time.
True.
This is intended for someone that has multiple buildings and they're essentially doing everything for the buildings, or real estate professionals. They will qualify. So yeah, have a nice journal, log everything, keep all your receipts, 50% of your time, 750 hours, you need to prove these. So reducing active income with passive losses, that's the one we just discussed. The second one is cost segregation. A lot of people don't know about this. So what is cost segregation? By default, when an investor purchases real estate property, a residential real estate property is depreciated over 27 and a half years. A commercial property is depreciated over 39 years. What this means is you can't buy a $1 million property and take a $1 million deduction the year you buy it. You have to depreciate it over 27 and a half or 39 years, depending on the type of property you're buying, okay? And only the structure, the improvements are depreciable. The land is never depreciable.
Yeah.
However, if someone purchases a commercial building that is nicely built up, perhaps comes with furniture and fixtures and chandeliers, right? Maybe the building that we're sitting in now. It's not just structure. There's a lot of expenses spent on other than structural construction expenses. So what we're saying here is, rather than waiting 39 years for all of these, for this cost of this building to be depreciated, broken down between different components, different assets that have different useful life. For example, furniture fixture has shorter useful life than the construction, than the air conditioner. So in cost segregation, they take the building, they break it up into different components, into different useful lives. So then they will know that, let's say it's a $2 million purchase. $1 million, let's say, is the cost of the land. So that comes out. The other $1 million of the $2 million is broken down to what is a structural improvement, what is construction, and then furniture, fixtures, equipment, carpets, air conditioner. These assets, different assets have different useful life. So the ones that have a shorter useful life, they take a faster depreciation, and the construction then is depreciated over 39 years. Was I able to explain that, or should I repeat something?
No. That was very, very good. And like you said, not many people are aware of it. It's a huge thing, yes. And not many people are aware of it.
So cost segregation is quite helpful for someone that has a lot of income now, wants to buy property and wants to use as much of the expenses from this property to offset their income. So rather than waiting 39 years for the property to be depreciated, commercial properties, 39 years, and 27 and a half years again for residential rental. If they do cost segregation and it turns out that the building has assets that have shorter useful life, it will get depreciated much faster, so they will have faster depreciation in the beginning.
Remind me, I need to connect you with one of my good friends. He actually brought up the question yesterday. He's purchasing a multifamily in Houston and wanted to speak to someone that's knowledgeable about that. So sure. I'll connect you guys for sure. So Jerry, tell us, I know you're very passionate about what you do, and you enjoy it, and you love helping your clients. Now, when you're not helping clients strategizing and preparing and saving them on taxes, what do you enjoy doing on your free time?
I love the nature. I love hiking.
Okay.
To be honest, I spend awful too much time reading. I read a lot about self-improvement philosophy, business. So, yeah, I love reading. I love getting educated. And I have good friends. We spend time going out, having dinners, spend time with my family.
So always working on yourself to get better as well, right?
That's
what
just
it's all
stuck
about.
with me. I'm always working on self-improvement. I'm one of those people that wants to learn, wants to be stable, wants to understand more. And yeah, so I spend a lot of time reading books and improving myself.
Awesome. This was extremely fun. As we wrap up our episode today, can you tell our listeners what's the best way for them to reach you and learn more about your services?
Right. The best way to reach me is probably to text me or to call me.
Okay.
My office phone number is 818-500-7117.
Okay. Awesome. And we're going to have more information about, Jerry and his contact information down below, as well as his bio. So again, Jerry, thank you so much for joining us. Thank you for sharing this wealth of knowledge. Truly appreciate it. And, we learned a lot today.
Thank you. Thank you for having me, Alex.
Of course. Thank you all for joining us on the Burr Investor Podcast. If you found today's episode helpful, please hit like and subscribe to our channel for more real estate insights. We love hearing from you, so please leave your thoughts, questions, or topics you'd like us to cover in the comment section below. Be sure to check out our website, theburrinvestor.com, and follow us on social media at The Burr Investor. Keep learning and investing, and we'll see you in the next episode. I'm your host, Alex Nale. Stay invested.